Welcome. This is MoneyHeart, where we explore the emotional side of money. I'm Camille Diaz, and today we're discussing life insurance secrets. My guest is Brian Heins. He is the owner of Firm Foundation HR and is a financial advisor. Brian, welcome to MoneyHeart.
Welcome, Camille. Thank you for letting me on your program.
Yeah, I'm really glad that you're here. Whenever I have somebody on the show, they always get to kind of dictate what the topic's going to be. So we have a chat beforehand and we figure out, what's interesting to them and what life stories and information they have to share. And then that's how we pick what we're going to talk about. So Joshua Fisher, who was on a couple of weeks ago, introduced the two of us. And when I talked to you, you brought up something that is actually the thing that I do every day, but never share with people on this show because I'm not the one making up the topic all the time. So I was super excited to chat about this topic, chat about how powerful life insurance can be, and share this kind of big secret with everybody, which I think shouldn't be a secret, but somehow it is. We're just not getting taught this little piece. So I'm going to try to stop nerding out and give you a chance to actually share this topic. So tell us how life insurance is like the best kept secret ever.
Yeah, well, I guess maybe start with the unsecret. When you think about life insurance, the first thing you think about is what it is. Life is you're insured at death, you pass away, and the beautiful thing is of life insurance, the proceeds of the policy go to the heirs tax-free. So you think about life insurance as a piece of your financial plan. And it's really good stuff. You leverage money and so forth. And so I'm gonna divide death benefit. I'm gonna call it. And what we're not going to talk about, just to contrast, we're not going to talk about like a term life insurance or even permanent life insurance. And term has a specific purpose for it. Typically, like you insure yourself if you have a mortgage or you have a college for your kids. And if something happens to you, unfortunately, you've eliminated your potential to earn and to produce and to make money for your family, for yourself, for your life, and for your goals. And you leverage a term, very inexpensive, and it has a large face amount, and it's able to pay for some of those things that are valuable to us. And so I'm calling that looking at life insurance from a death benefit.
Yes. And that face amount and death benefit, those words are kind of interchangeable. It's the amount that your beneficiaries get when you pass away.
Absolutely. Yep. Okay. And so that is a very good way of looking at life insurance. There's a place for that. We're not talking about that, but I just want to support it with that. And also for the side of it that we want to be clear that what we're saying now and the secret is a life insurance as a living benefit. And there's some advantages because there is some rules with life insurance that we're going to take advantage of here from a tax perspective. Two of them specifically. First one I've already mentioned is the face amount of the policy does go to the heirs tax-free. And so from a living benefit and supporting an income as we're living, even if you pass away early, it vests immediately.
So just to explain what vests means, because sometimes you might know that word if you have like a 401k and you have to wait until it vests before you get to keep all the money or something like that. But just explain it so that everybody knows exactly what that is.
Yeah, that's a good way. 401k. If you would have a 401k, you might, the employer might contribute a certain percent to you, and the way they can create and set up the 401k, the way the plan might be. It might be have a vesting period. So you might have to be with the company for 5 or 10 years before the money that they contribute into your account is yours when you leave. So when you're terminated from employment, if you haven't vested it all, they'll take part or all of it from you. But so in this case, the beauty of this is there's no vesting. So it vests immediately. So once the secret to this plan, the first tax advantage that we're talking about is it vests immediately, which means 100% of the face, or like you said, the proceeds of the life insurance policy go to your heirs, all of it tax-free to your heirs. And so that's an advantage, because if you don't live long enough, you can fund what you want and for your family with the policy. So the first tax advantage is life insurance goes to your heirs tax-free.
So day one, I get all signed up, I get approved, whatever. I send my money in, so I've paid my first month, and immediately, whatever that face amount is, if I took out $500,000 policy, if I get hit by a bus the next day, my family gets that $500,000 tax-free.
Absolutely.
Beautiful.
And that's the first step. So we're looking at life insurance from a living benefit, and that's the unfortunate side. And then the second is what we're going to talk about, and I'll just say it and then we'll go through and talk about it. The second advantage of life insurance, as the cash builds up within the policy, is you can take it out in the form of a loan tax-free. And so we'll talk about that. And the way I'd like to talk about it is from a comparative standpoint. And so I'd like to talk about this policy that you might take out, and whatever kind it is. And it's good to have a financial advisor that you know of, that you trust, and can structure it the best way for you. And so the way that we're going to do this is we're going to compare setting this up, life insurance as retirement, or life insurance secrets as drawing from this and creating a pension, a payout when you're retired. So you're going to get this and get it paid out to you later on in life. We're going to compare that with what you would do if you came to me as a financial advisor and said, Brian, let's go ahead. I'm 35 years old, or however old I am. I have a given number of years here. I want to invest in an IRA or a 401k, or I want to invest put the money over tax deferred. How much money, the question is, would I have to create over here then to pay taxes on it later on? How much money would I have to create to make a certain amount of money as a pension to support myself at retirement? So that's what we're going to compare. Within the life insurance policy, the proceeds coming out tax-free, and that's what we're going to talk about, versus outside, when the proceeds of the cash buildup come out and you have to pay taxes on it in the tax-deferred environment.
So that's kind of a huge thing there, is if you're putting money into, let's say, a 401k or IRA, something along those lines, you're putting money in pre-tax most of the time. Is that right? So it's coming directly out of your paycheck and you haven't paid taxes on it yet. So it's growing tax deferred, but when you get to the end, you have to pay taxes on everything as you take it out, right?
Yes, and this is something that so we can illustrate. There's like called hypothetical illustrations, and your financial advisor would want to, your person that you trust would want to show you this in like a black and white numbers kind of a form. Kind of in our conversation here, it's hard to get into your specific numbers and compare them, but you want to look at this and compare it, because like you said, it's tax deferred, but when you take the money out, like an IRA or 401k, you're paying taxes on it. And there's a lot of money coming out, hopefully, because you've been diligent and taking the money out. And so there's a good chunk of taxes. And you want to compare that with the secret of life insurance as an investment and as a retirement pension within the policy. As you take it out, and here's the second tax advantage of life insurance. You can take it out in the form of a loan. Now, there's two ways you can take it out. You can cash, it's your money and it's within your policy. You can cash your policy out, turn it in, you get the lump sum, whatever the cash value is. And that's your right to do that, but you will pay taxes on that at that point. The other way that you use these policies, and this is what we're saying the secret is you take it out in the form of a loan, and it equals out to be a interest-free loan. It's your money. you're taking money out of your policy. And the illustration that you could see, and you could have your professional show you, is that you can take it out if you want, like annually, a certain amount of money, or monthly or annually, and you start taking the money out, and you see what that amount is tax-free, can back over to your IRA if you dedicated all your resources to your IRA 401k to compare that with paying taxes on the amount of money that you're taking out of that investment. So,
right. So I think you're right. People don't always think about that. They think, well, when I start taking my income, I'm going to get, let's say, 60,000 a year from my investment. Okay, awesome. I did a great job. But if you're going to subtract taxes from that, okay, now I only have maybe 45,000 that I actually get to live on, versus if you're taking it out in a way from a life insurance policy that allows you to take it out tax free, you're keeping the whole 60.
yes, for sure. And so it's an advantage. And so yes, agreed. Now, one other thing is that the way you should have this illustrated to you is that, and by the way, I am for and pro IRA, maxing your IRA out and maxing your 401k out. I'm for that. Do that, but I'm saying consider this as a supplement or as another piece of your retirement plan. Is what I'm saying. First of all. Second of all.
And also, especially if your employer is matching for you and you're going to get some free money from them, we wouldn't want to pass on free money.
Oh, never. Yeah, even if it's vested, and you more than likely, if you're going to contribute that, hopefully it's a good job, you like it, you're going to stay there long enough to get the 100% of the vested amount. But yes, we like when the employer pays part of our investment in retirement for through our 401k.
And I like that concept of having a multiple things that you're doing, not just relying on, I've got this one nest egg and that's it, and that's the only thing I'm doing, but rather spreading it out between a couple of different ways and a couple of different strategies.
Yes, and I brought up the word pension, and it's this is like a pseudo pension that we're creating here, and you're right. With your 401k, with your employer, and then you have that, and we like that, and that is that brings at the end of your retirement, it's a lump sum, and you're going to have to make a decision on how that's distributed to you. And this also is a really cool way to increase the amount of streams of income that you have for your retirement.
Yeah.
So, and the other thing that to compare with, and the outside again, because I'm going back and forth here, but your 401k is that the question that I have when I sit down with people to show them the illustrations and to kind of think about this is that what's the amount of money that you have to have outside to have a certain amount of stream of income, certain amount of money per year, like a pension. And so there's what's called a rule of 4%, a 4% rule, and that's what financial advisors use that. And what that is that you create a pool of money, we'll call it, and to take out 4%, and that typically will last you about 35 years of taking 4% out of your investment before you exhaust it. And so a way to look at it is, how much money you can project at the ages, whatever retirement is these days. It's not 65, maybe it is, maybe it isn't if you're old school, but so earlier, later, whatever, at a certain period of time that you project and you have a goal, and you set that up, and you have a certain amount of money you're projecting. You can look at that as the 4% rule of taking money out, and you can see how much money that pool would provide to you. In comparison with the life insurance policy, is that's kind of hard to figure that out, but you should be able to do that, especially with some help. But within the life insurance policy, and what we've talked about is that it actually shows it to you, black and white numbers. It can illustrate how much money the proceeds of the policy will provide to you on it could be on a guaranteed basis issue. And so you can see that within the illustration. And so what you'd be looking for is a hypothetical illustration, and have them at a certain period of time, your goal when you want to quote unquote retire, to start taking the proceeds out. And that should be able to see how much money that is, and to add to your retirement.
Yeah, and we'll put a sample illustration on the website so that people can go to moneyheartshow.com and find this episode and click on that link there to kind of see a sample of what an illustration might look like. Of course, it won't be accurate for them because it's a sample, but it'll at least show, here's how the money goes in and here's how it can come out. The cool thing about this is a lot of them, when you switch it on, they have the option to do this guaranteed lifetime income piece. So that once you're turning it on, like you said, it's like a pseudo pension, or a similar concept, that you're not going to outlive that money, which I think is a big fear for a lot of people when they're thinking about their retirement money.
Yes, yeah, it is for sure. A good point, Camille. And we're talking about, there's nothing perfect in life, and there's risk with everything. But when you wrap it within a life insurance policy, and taking advantage of the two tax laws that we just talked about, this is a very favorable approach to retirement planning.
Yeah.
And so that's that's a good thing. And then the other thing is that just going down my list of thoughts that I would present in this conversation that we have, is that you have different ways to invest your money within the policy, or you could say you have different policy choices.
Mm-hmm.
And so you want to figure that out and learn about those. I can go through kind of a quick list so that everyone has kind of that, and you can talk to your professional about it. Within what we're talking about, using life insurance, it's a secret, using it as a pension, as a payout, as a living benefit. There's one way that you could set this up is through universal life. And universal life pays bonds. It has bonds and it pays bonds. The other way is a whole life policy, the mutual companies, and they pay dividends into the policy. And there's variable life. Variable, if you're comfortable being in the market goes up, you make money, market goes down. Your policy could actually lose money that way. Just have to be aware of that. The fourth way that you can illustrate this is with indexed universal life, and you can index it to a number of different strategies within the one policy. So you can switch from one investment strategy to the other as you move forward within your policy. And the universal life, you index it to like the S&P, the Hang, the Dow, all depending on what investment strategies are within there. But so there's things in there, and the one that you talk to assist you with this will be able to help you choose what kind of policy, and then choose what kind of investments that you want to do, and should be able to work with you on an advising basis to make the best out of your policy. Because the goal is, and the secret is, like Camille, is that we can take the money out of this tax-free. It's the IRS does not need to be reported to. It's illegal. It's not 1099. This is taking money out of the pension. You could say it's somewhat like a Roth IRA as far as on the back side of it, because you take it out and you do not pay the taxes for that.
Right. Yeah. I sometimes refer to this with people as like a Roth on steroids, because you get the benefit of getting the money out tax-free, but it doesn't have those limitations of how much you can put in. So you're not restricted per year of, I can only put 6,000 or 7,000 or something like that. Hey, if you make lots of money, you want to put it in something and get it back tax-free, go for it. You can do that. So
Yep. Yeah, you can push money into this. And as far as us nerdy people, and maybe if you're the kind of person like the details, it's called a minimum non-MEC, and that's specifically minimum non-MEC. Write that down. And that's specifically the way that your advisor would structure the policy. Mm-hmm. And so what that means is that there's a cost of insurance in the policy. You want to push that down low as possible, because you want to have the lowest amount within this living life insurance program that you set up. Push that down, and you want to push into the policy, max out the amount that you push in on the money buildup side of the policy.
Right.
And so, yeah, they'll be able to do that for you. You're right. And you want to push as much into this, and it works out. And it'll have it illustrated to see and project how that's going to work for you.
Yeah. Yeah. And I would recommend finding someone who does these regularly. I've had a couple of people tell me stories of, oh yeah, I did one of those, but it didn't work. You know, I hear that every once in a while. And typically that's when you work with an agent or an advisor who is not familiar with how these work. And they're not building it on that min-max principle where they're trying to make sure your cost of insurance is low and your cash value is high. So important to find someone who, when you bring up this concept, hey, how do I create money in my insurance policy and get it back tax-free? And if they get all excited and they're like, yeah, let's do that, then you found the right person. And if you find someone that goes, you want a term policy? Then it's probably not the right person. So.
Yes, for sure. Yeah, and we all have. I've run across policies, unfortunately, was not set up correctly, and they basically did not last. You know, they, and then the owner of the policy, or would have to fund it, put more funds into it just to have it last. But yeah, you want to create this to be the on the living benefit side, and someone that understands that to set this up for you well.
Yeah, definitely getting someone that understands. So this is kind of interesting because this is probably the reason I even got into this business, is when I learned how this works and I said, wait, I can put money over here and it can grow in such a way that I'm not at risk of losing anything. And then I can get it tax-free and it can come to me for the rest of my life so I don't have to worry about running out of money. And if I pass away early, my beneficiaries are all taken care of, so my kids are good. All in one thing. So I've got tax-free and guaranteed lifetime income and retirement. But that's it? That's all I have to do?
No,
Fabulous.
I tell you, I just don't believe that. That can't be true.
Can't be true. Too good to be true. Too good to be true.
But it really is true, and
It really is true.
it's a piece, and it's good. It's good good stuff. I say it's a good way of looking at it as a part of what you want to do with your plan. Because we work hard. I talk to my clients, typically are business owners, but anyone, I help anyone, but a lot of business owners, and I'm a business owner myself too, and I there's the stresses, and not just myself and what I do, but I have the employees I have, and so we have to support their jobs and their careers with our company. So the pressure's on, and I love what I do, but I love helping people and serving people, and what the kind of company we have. But also a goal of my company and doing what I do, taking the risks that I have taken, is to put money aside to do these kind of investments to support myself at some future date. Mm-hmm. And so yes, we're gonna we're gonna look at more than one of these ways to invest and to create a good, more of a secure, more of a balanced retirement fund portfolio versus just put them all in the 401k and hope it when we retire the market's up, and then we take the money out, and then what do we do with it? And so and then frankly that's what I hear a lot of times. At financial advisors, the way I sit down, that's what I am, and so I've heard other people, and I sit down and talk with them, and they say, the advisor, when I initially started or whatever, they talked about money coming in to this program, to whatever they were suggesting to do, but they never talked about the money coming out, because this is a secret, because the money coming out is taxed, and it's less than the pool of money. And so what we want to talk about is the money coming out, because that's reality. Reality is that someday in the future, I've done all this work, helped serve. I feel good about what I've done in business, life, community, and now I have this. I've done my due diligence to look at this money that's coming out and maximizing that to my benefit sometime in the future.
Yeah. I think that's a great point, because you touched on a couple of things there. One is, the big one is thinking about how the money is going to come out. And wherever you're putting it, when you're setting it up, okay, how am I going to use this? How is this going to benefit me? What are the taxes going to be like? How am I going to be able to access it? Am I going to make sure that it's going to last? All of that stuff is questions to be asking up front, which I think a lot of people kind of gloss over. They just go, I know I have to save, I know I have to invest. They have no plan for when I'm using it, how I'm using it, how much I'm going to get, what the tax situation is going to be like. All of that kind of stuff. The distribution piece needs to be a big part of the initial conversation, and it's often not. And you also talked about a couple of times having multiple accounts, because that allows you to you can have more flexibility in that how am I going to use it plan. You can say, well, I'm going to use this one now and I'm going to let this one keep growing, and then I'll turn it on in a few years when, I'll work part-time for the moment, and then later on, or maybe I have a health thing, and so now I got to switch another one on, kind of a deal. But it gives you options when you get to that stage, rather than, like you said, if everything's all in one place, one basket, one lump, you take it out or you don't. You have it or you don't. And you're kind of stuck. You don't really get to choose as much what works for you.
Yeah, yes, for sure. Yeah. And this is again, back to my first talking about looking at life insurance from a death benefit, a temporary benefit. This is looking at it from a permanent benefit and a living benefit.
And the permanent benefit extends beyond just yourself. If you haven't used up all the money in there, your beneficiaries are still going to get that benefit when you pass away. So that's even better, because now you've built generational wealth.
Absolutely. Good point. Yes.
I love setting these up for kids so that they're already on track, because the cost of insurance, you mentioned, there's that little cost of insurance there, is so low when they're young that, hey, instead of plastic toys, give them the cardboard box, because that's what they're going to play with anyway, and then throw a few $100s into the plan, and you got millionaire kids by the time they retire.
I have people come to me literally numerous times, and they're in their 50s and 60s, and that's where I'm at now. And they sit down with me and they say, well, I have a little high blood pressure. Oh, I'm a little bit diabetic. A little bit diabetic, they tell me. And so, can I do this? And I say, well, you can, but really maybe we'll look at something else. I say can, but really probably not. And yeah, you want to take advantage of this now while you're healthy, or even if you do have an issue or two now, it's probably going to be better now than it will later.
Right.
Even though we think a little bit of hypertension, we're going to change our diet or whatever, at least get this now. And then in a couple, 3 years from now, if as your health increases, if you do accomplish that, which is awesome, yeah, then maybe look at replacing it or whatever. But this is something to do now while we're healthy, and as soon as we can look at the due diligence on this particular kind of a pension.
That is a fabulous point, in that you can only use life insurance as a tool as long as you can qualify for the life insurance. So even if you're just putting a term policy in place, because that's what fits in your budget right now, not a permanent one, those term policies can be upgraded to permanent policies with pretty much every company without doing additional health underwriting. So if all you can do is put the Band-Aid on it, get the term policy within budget, you could do that, hold it for a few years and convert it over, and it kind of locks you in. So if you had a health thing, it's not going to hurt your ability to be able to use this as a tax advantage strategy for the future. So yeah, and it's cheaper. I mean, a life insurance cost is based on age and health. So the younger you are and the healthier you are, the less it costs, the more of your cash goes to the cash piece.
That's right. Yeah, absolutely. Yep. So agreed. And so yeah, you want to look at these. Look at this as a piece. So yeah, that is life insurance secrets today.
I love it. Yeah, thank you. This is fabulous. Tell us a little bit about what your company does.
Yeah, so I'm a partner of Firm Foundation HR, and we're based in California, but we're national too. So what we do is we help support we outsource payroll and HR services to small businesses and to non-for-profit organizations. And so we do that, and we're insurance guys also. So we do the workers' comp, liabilities. We do benefits to help the dental, vision, life. I manage 401ks. That's why I know about them. And, pro 401k, but just, there's just a rabbit trail on the 401k. There's a lot of expenses, by the way. There's a lot of fees built into 401ks. I do them, I manage them myself, and it's you can do better. Then do that, yes, but you can do more than that too. So, that's what I do, and my part of this, I've done it for 20 years. Is just 20 years this year. Is the benefits. I oversee that, and my strategy is for all these years is to use the benefits and help people with their health, dental, vision, life. A lot of servicing on that side, and I meet and I develop relationships with business owners and to do their financial advising, individual financial advising for them. And so that's what we do.
And our advising and life insurance things are usually state limited. So I know your payroll service is probably nationwide. Where are you licensed for your life and financial advisor services?
Yeah, I mean, it's been maybe about 8 or 10 different states, and and so it's not every state. But if somebody is in a state and they need some basic advice like we're talking about now, I can talk with them and refer them. Or again, if it's a case, getting your appointment to a non-resident license in a state is very easy. So
right.
we could do that also. But I'm in California. You're right, West Coast. You have a lot of Nevada, Arizona, California, and also 20 years I lived in Oklahoma too, like you. But I really have left the Oklahoma, Texas area myself. Yeah. So, but yeah,
which is perfect because that's one of the reasons.
Which we're a good fit. Yeah.
Yeah, we're a good fit. That's one of the reasons we're a great fit, because you've got all the West Coast stuff, and I have the Oklahoma, Texas, Kansas, Tennessee area, stuff like that. So we don't really overlap in where the areas we help people, which is great because it means we're serving more people.
Yeah, and I would say you really want to develop a relationship with a person. So like if you're a local person, you can sit down with them or Zoom with them these days.
Right.
It's an advantage because this is just to reflect on what some of the things we were talking about. This is not you don't just purchase it and then you just put it in your folder. A good advisor will help you internally with your investment choices. And even throughout the policy, you can move money around within there. So yeah, you want to know the person and have them like you said, local is helpful.
Yeah, it is helpful. It is helpful. Thank you, Brian. This has been fabulous. I'm so glad we got to chat about this.
Yes, it's fun. I enjoy talking about this subject because I strongly believe in it.
Yes, me too. Me too. If you'd like to get in touch with Brian, you can call him at 949-413-3282 or send him an email. His email address is brian@ffhro.com. That's as in Frank, hro.com. Thank you as well to all our listeners and viewers. I'm your host, Camille Diaz. This show is sponsored by Serenity Financial, a 5 Rings financial agency specializing in financial education, living benefits, and guaranteed lifetime income. Be sure to follow MoneyHeart on social media at MoneyHeart Show and on our website, moneyheartshow.com. Brian provided us with today's money mantra, which is, it is not only about your investment dollars going into your plan, but out of the plan. Thank you so much.